Hi, welcome to Dig Into China. I'm Dong Shang. Thank you for tuning in. Your liking, sharing, and subscribing not only show your support, but also help YouTube recommend my videos to a broader audience. Thank you very much. Today, let's delve into the recent debt turmoil surrounding Vanke Group. Vanke Group stands as one of China's foremost real estate developers, which with its headquarters situated in Shenzhen, established in 1984, the group ranks among the earliest joint stock real estate enterprise in China. Vanke's presence in the real estate realm spans across residential, commercial, office, and hotel sectors, with operations extending across major cities nationwide and into select international markets. As a frontrunner in China's real estate sector, Vanke is dedicated to delivering top-tier real estate products and services while actively engaging in social responsibility initiatives and sustainable development endeavors. By 2021, Vanke Group had cemented its status as one of China's most influential real estate entities, boasting a stellar reputation for both its business scope and brand recognition at home and abroad. The foregoing encapsulates an official overview of Vanke Group. Starting from 2021, China's real estate sector has undergone a sharp downturn, witnessing the crisis of Evergrande in 2021, Saga in 2022, and a Country Garden in 2023. Now, is it Vanke's turn in 2024? Is there a pattern emerging where a top real estate enterprise faces a crisis each year? What are the specific issues affecting Vanke, and how do they differ from those of Evergrande and a Country Garden? Furthermore, is Vanke a candidate for rescue? If the Communist Party is committed to saving Vanke, what could be the most appropriate strategy? These are the questions we'll tackle in this episode. First, let's unpack the context surrounding the recent Vanke incident. On March 3rd, rumors began circulating in the market. It was alleged that Xinhua Asset Management, a subsidiary of Xinhua Insurance, had provided Vanke with a 10 billion yuan non-standard debt, originally due for repayment in December of the previous year. Later, both parties negotiated a 3-month extension, meaning Vanke was expected to repay the debt in March of this year. However, when the deadline arrived, Vanke sought to extend the repayment period further, only to be refused flat out by Xinhua Asset Management. Consequently, speculation arose regarding the possibility of Vanke facing a debt default, causing significant market unrest. Following a previous downturn in both stock and bonds last November, Vanke found itself once again subjected to dual market pressures. Subsequently, Xinhua Asset Management issued a public statement to dispel the rumors. While the statement seemed supportive of Vanke, it notably did not refute the fact that Vanke had approached them for an extension. This indirect confirmation of the rumors only compounded Vanke's challenges in both the stock and bond markets. In response, Vanke remained silent, only breaking its silence on March 8th with an announcement that it had prepaid a $630 million medium-term notes ahead of schedule. This declaration finally reversed the downward trend in Vanke's stock and bonds. Bonds, which had previously taken a hit, began to regain ground. However, on March 11th, Moody's downgraded Vanke's credit rating to speculative grade, effectively classifying it as junk bonds. If Vanke's rating drops below investment grade, it could force holders of high-rated bonds to sell Vanke stocks, dealing a significant blow to the company. Furthermore, Vanke's ability to raise funds internationally would be severely diminished. In response to the negative rating downgrade on March 12th, prompted by the People's Bank of China, Vanke swiftly delivered a much larger positive message to the market. It announced that 6 major state-owned banks, Industrial and Commercial Bank of China (ICBC), Agricultural Bank of China, China Construction Bank, Bank of Communications, and the Postal Savings Bank of China, along with 6 joint stock banks: China Merchants Bank, China CITIC Bank, Industrial Bank, Shanghai Pudong Development Bank, China Minsheng Bank, and Ping An Bank had formed a consortium. This consortium would provide Vanke with an 80 billion yuan credit line led by ICBC. Following this announcement on March 12th, both Vanke's stocks and bonds saw an uptick, suggesting that Vanke might have weathered the debt crisis with minimal damage. However, is this the reality? Will the 80 billion yuan credit line from the consortium of 12 banks actually materialize? Let's begin by examining the origins of Vanke's crisis. Despite being a top player in China's real estate sector, Vanke had been downsizing its operations in recent years, citing the necessity for survival. Why did it face a simultaneous downturn in both its stocks and bonds at the end of last year? The core issue lies in Vanke's considerable decline in sales performance. Understanding the operational model of real estate companies, when a property developer acquires land, they usually secure loans from banks using the land as collateral. Subsequently, they construct buildings and sell them to buyers, using the sales proceeds to repay the loans and cover construction costs. However, if properties remain unsold, it directly impacts their ability to repay loans or cover expenses. Understanding this reasoning, let's explore the changes that have unfolded in the Chinese real estate sector over the past couple of years. Previously, when Vanke acquired a piece of land, for example, if they purchased it for 1 billion yuan, they could typically secure a loan for up to 70% of the land price. This means they could obtain a maximum development loan of 700 million yuan. However, with banks tightening their lending practices, even leading real estate firms like Vanke might only secure a loan of up to 500 million yuan. Consequently, does this imply a shortfall of 200 million yuan? Moreover, previously, when properties sold well, for instance, if they sold out within a month, generating 1.2 billion yuan in revenue, this income would easily cover construction costs and loan repayments. There might even be surplus funds available for further land acquisitions. However, in the current scenario, it's possible that the properties may not sell out even after 6 months. Additionally, the regulatory accounts, once supervised by banks, are now under government oversight. Consequently, Vanke cannot freely access the funds in these regulated accounts. Therefore, even though they may have sold properties worth 500 million yuan with that amount sitting in the regulated accounts, Vanke can only access 100 million yuan in actual liquidity. The remaining 400 million yuan is effectively immobilized. This 100 million yuan might barely cover construction expenses and the loan interest payments, leaving minimal additional funds available, thereby constraining Vanke's cash flow. Let's examine Vanke's sales decline this year. In the period from January to February, Vanke only received 33.45 billion yuan in property sales, which is merely half of the amount from the same period in 2022 and 58% compared to the same period in 2023. Such a drastic decrease is undeniably alarming. At this rate of sales decline, Vanke's revenue for this year is estimated to be only about half of last year's. In 2021, Vanke achieved sales revenue of over 370 billion yuan, but this year it may be reduced to only about 200 billion yuan at the most. A 50% reduction in revenue presents a substantial challenge for any company. Unless a company has substantial reserves and a large amount of cash assets accumulated, it would be challenging to manage debt issues. Furthermore, China's real estate sector operates on a high debt, high turnover model. Even the most conservative firms like Vanke have amassed total liabilities of 1.24 trillion yuan. Hence, no entity is immune to the test of significantly diminished sales revenue. This forms the primary catalyst for Vanke's debt crisis, a decline in sales coupled with tightened regulations on fund access, leading to a substantial decrease in Vanke's incoming cash flow. Moving forward, let's delve into Vanke's approach to the situation. I remember our previous discussion about the Vanke, during which I shared my analysis. Firstly, I suggest that the Vanke should be able to handle these short-term debts, given its substantial cash reserves as evident from its financial reports. Secondly, I pointed out that the Vanke's sales of high-quality assets is a strategic move. Today, I stand by these points, but I'll elaborate on them further for clarity. Let's start by examining the current situation where Vanke's negotiations with insurance companies regarding debt extensions primarily involve non-standard debts, correct? When it comes to standard debts like bonds and bank loans, Vanke has consistently ensured a timely repayment without the need for extensions. In fact, during the stock and bond market downturn last November, it was only through assistance and communication efforts with its major shareholder, the Shenzhen State-Owned Assets Supervision and Administration Commission, that debt extensions were successfully negotiated with insurance companies. Therefore, Vanke's strategy is clear. Prioritize timely repayment of standard debts while seeking extensions for non-standard debts, thus preserving more cash assets to handle potential further declines in sales. Therefore, it's not that the Vanke lacks the funds to repay these non-standard debts, rather they are opting to preserve this capital. This strategic decision reflects Vanke's pessimistic assessment of its sales decline. They are preparing for the worst-case scenario by aiming to retain a larger cash reserve to meet the maturity of standard debts. Consequently, as long as they can ensure timely repayment of their standard debts, Vanke could emerge as the most resilient entity in China's real estate industry. The logic is sound. Let's reflect on Xinhua Insurance stance. Why did they reject Vanke's plea for another extension? It's because Xinhua Insurance understands that the Vanke indeed has the financial resource to repay them. Why should Vanke hold back from repaying them and insist on an extension? Is this the underlying rationale? If Vanke truly finds itself in dire straits, Xinhua Insurance might not have the courage to decline. They would have to accept the extension even if they had initially refused. Take a look at Evergrande and Country Garden's creditors. Haven't they both quietly accepted debt extensions? Vanke's non-standard debt totals only 25.38 billion yuan, with just 6.15 billion yuan due within the next 2 years. This sum isn't significant, especially considering Vanke still holds 100 billion yuan in cash reserves. Therefore, it's clear that Vanke hasn't reached a desperate situation yet. Moreover, Vanke's asset quality far exceeds that of Evergrande and Country Garden. It boasts a larger reserve of land in first and second tier cities, and it enjoys the support of a major shareholder, a state-owned enterprise. It can be argued that Vanke is superior to 99% of China's real estate enterprises. Therefore, irrespective of the cost-benefit analysis of the Communist Party's decision to bail out the Vanke, it clearly outweighs that of Evergrande and Country Garden. Vanke is undoubtedly deserving of rescue. Yet another question arises here. Will the consortium of 12 banks providing a lifeline of 80 billion yuan to Vanke resolve its underlying issues? The answer is negative. Firstly, the feasibility of this syndicated loan of 80 billion yuan remains uncertain. Secondly, 80 billion yuan is a substantial sum, so what collateral will Vanke provide? Unsecured loans are out of the question. What other assets does Vanke have that it can use as collateral? Given the current situation, Vanke has likely already used up all the assets it could use as collateral. So, the only solution I can think of is to introduce a state-owned enterprise major shareholder to provide the guarantees. However, whether the Shenzhen State-Owned Asset Supervision and Administration Commission will go to such lengths to support Vanke remains to be seen. This would essentially mean providing substantial financial support to Vanke, which requires significant courage. In summary, moving forward with this transaction is certainly not as straightforward as anticipated. The announcement of this news at present is merely aimed at stabilizing the market and dampening bearish sentiment towards Vanke. Nonetheless, let's consider a hypothetical scenario. Even if the 80 billion yuan is promptly loaned to Vanke, how long can Vanke sustain itself? In 2024, Vanke faces a total standard debt repayment of approximately 17 billion yuan, including 10 billion yuan for overseas bonds and 7 billion yuan for domestic credit bonds. While the infusion of 80 billion yuan can indeed provide Vanke with a few more years of support, it's merely a short-term fix that doesn't address the underlying issue. So how can we fundamentally rescue Vanke? There is only one solution: addressing the challenge of declining sales. Expecting domestic buyers to continue purchasing properties in the short term is unrealistic. The most pragmatic approach at the present is for the Communist Party to acquire Vanke's properties and initiate long-term rental housing projects. Certainly at the present, the most viable strategy for reducing housing inventory in the domestic real estate market is government acquisition. However, a significant challenge arises. The current housing inventory stands at a staggering 500 million square meters. How much of this inventory can realistically be acquired by the Communist Party? Without the financial support from the rental market for the acquired properties, such an acquisition would essentially amount to a donation, an unlikely move for the Communist Party. Moreover, would properties held by state-owned enterprises be given priority in acquisition? It's natural for state assets to remain within the state entities. This places Vanke in a precarious position, being part state-owned and part private enterprise. The level of government support it can expect remains uncertain. Following this line of thoughts, it's evident that the Chinese real estate sector is heading towards a stormy and perilous period. Under the pressure of high inventory, numerous real estate companies are expected to collapse, with only those receiving financial support from the government able to survive. Recent statements from the Ministry of Housing and Urban-Rural Development indicate a tough stance. Real estate companies heavily indebted and incapable of operating will face bankruptcy or restructuring. This message is undoubtedly directed towards private enterprises. It's clear that central and state-owned enterprises have the highest probability of survival. Next in line are the awkwardly positioned semi-state-owned enterprises like Vanke, with privately owned enterprises likely to fare the worst. I believe Vanke has a relatively high chance of surviving, especially if we witness the Shenzhen State-Owned Asset Supervision and Administration Commission stepping in to guarantee syndicated loans for Vanke, which would be the best-case scenario. Conversely, even in the worst-case scenario where Vanke doesn't receive preferential treatment with financial backing to acquire properties, given Vanke's resilience, it could still manage to survive for another 5 years without any issues. During this time, Vanke can at least ensure that its standard debt remains non-defaulted. By enduring these 5 years, Vanke would already surpass 99% of real estate companies in China. Perhaps within this time frame, Vanke may even encounter its turning point. Who knows? We'll see. Thank you for watching. Please like, leave a comment, and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.